Hi, this is Danielle, and I'm the VP of Options here at Simpler Trading. And today we're going to be going through an option strategy breakdown where I'm going to be discussing calls, puts, spreads, and butterflies. So this is meant to be, an overview of each of these strategies and why you would pick one over the other. Definitely, you would want to have more information than this to actually put on any one of these trades. But what this is meant to be is it's meant to be an overview so that you can learn a little bit about each strategy and why you would select one over another, and then delve more into each one as you're learning to place each kind of trade. So let's just start off by talking about calls or puts. This is usually the place where people get started in options, primarily because it's, the next best step after learning how to trade just stocks or ETFs. It's the leveraged way to get involved in the stock market, and usually step one. There's some positives with this. Number one being it's really the highest potential for profit, but those positives are also going to come with some negatives. So for example, this is also going to be the highest risk option strategy with the potential for quick losses. Now, when new options traders get into options, they normally go for the easiest strategy with the highest potential of profit, right? But what can often happen is that they're not really realizing that is also the strategy that has the biggest potential for quick losses. And that's why you really have to learn how to effectively utilize them. They can definitely be used for account growth when done correctly, but the thing about options is that they're priced so that you will lose money unless you know when to buy them and how to buy them, specifically focusing on what kind of strikes you want to look at, and especially the expiration and delta. Now, of course, with a little bit of education as far as how to select your strike properly, that is how you go from turning this negative into a positive. So the thing about buying long calls or puts that is really important to understand is that you are going to make money on this trade only if the underlying trades outside of its regular expected move. Okay, so just in a normal situation, if the market's moving in normal ranges, nothing interesting about it. Nothing interesting about it. The option is not going to make money. The way that long options make money is if the market has a greater than expected move. So that's why it's really important for you to be able to identify a setup, which is when the stock market may experience a greater than expected move. So you are utilizing long options or calls or puts at the right time. If you just randomly, buy long calls or long puts without any kind of strategy as far as, when, why, or how, that is where you are at a very high risk of, losing your money. So that's why it's important to get education in all those areas. Now, many traders come to us with many years of experience trading stock or covered calls, but without experience using complex option strategies. So at first it can be a little bit daunting, but honestly the complex option strategies, I'm going to tell you, are far more beneficial for you as a trader because they really enable you to improve your risk to reward, and they also allow you to lower your risk. So when you first come into options trading and you're focusing on long calls and puts and trying to learn expiration dates and try to learn a setup, that is very, very critical. Those are the first steps, and you really need to do that as far as your options trading is concerned. But just keep in mind that the next step and the next level to that is going to be learning the more complex options strategies. So when we're looking at just a call, for example, why would someone do this? How would it work? Basically, what you need to think about primarily is if you're buying a call in the money, at the money, or out of the money. Now, it's very, very common for new options traders to think that buying out of the money calls is a great idea because they are very cheap. But here at Simpler Trading, we call those lotto trades. So if you're buying an out of the money call, that means that it's a lotto, which means that it has a very low probability shot of working. That's why here our traders primarily buy in the money call options. And this is because when you're buying an in the money call option, your break even price is going to be pretty close to where your option strike price is, which means that the market doesn't actually have to move a ton. It needs to move, it needs to go in your direction, it needs to go up if you're buying a call, but it doesn't have to have any kind of massive move. A lot of the time when people buy out of the money calls, those out of the money calls are cheap and they're very low probability. And what it means is that the break even price is just significantly higher, and the likelihood of it going in the money is also significantly lower, which is why it's so cheap. So typically at Simpler Trading, what we do is we usually focus on buying an option strike price that is going to be below the current underlying price. Okay, so if you look at this graph, what this is going to show you is that, let's pretend that the underlying price of the stock is right about here. Let's just say this is stock cash money, and the underlying price of that stock is $100. All right, that's the name of the company, Cash Money, honey. All right, so let's say that we want to buy an in the money option. That would mean that you would buy an option maybe like 97 strike. Okay, that would make it in the money. So what will often happen is people will say, okay, well, Cash Money is trading at $100 and I want to buy an option at the 120 strike price because I can get that for only 20 cents. Yay, it's super cheap. But if I pay for the 97 strike, I'm actually going to be paying, I don't know, $5. I'm completely making up these numbers, but just to give you an example. The thing about it is that because the 97 strike is actually in the money, it has real value. This option has no value, and because it's so far away from where the stock price is actually trading, that means it's a very low probability shot of actually working. With this one, because it's already in the money, it has an actual real value, and it just needs for this to move really slightly higher to get to a break even point. And then once you get a little bit higher, that's where your profit potential is really maximized after you get over the break even strike price. So in this example, if I paid $5 for a 97 call option, as soon as I got up to about $102 on the stock, that's where I would be past my break even point and I would start to make money. If it went from $100 to $102 and I had the 120 calls, I mean, I would doubt that that would maybe move maybe 1 cent, but probably not really much of anything until you got to around 117 or so, which would be a massive move. So this is generally how we set up our long options trades. We usually get around a delta 70. We usually get them in the money. Of course, it changes depending on the setup, but that is normally what we are looking for. So when you're buying directional options, you need to be able to read the options chain. So that is something that's really important. A couple different factors that we look at when we're looking at the options chain is going to be volume and open interest. We want to know if there's going to be enough liquidity. That's going to be in this column on Thinkorswim. Thinkorswim is a platform that a lot of our traders use, and I use it as well. But you should have volume and open interest in any platform. So basically, you need to be able to know if there's enough liquidity. You also need to be able to see when this option is going to expire, because options are going to expire. So looking at the weekly series or the monthly series and being able to identify how many days of life the option has is going to be really important. And then selecting your strike. That is going to start with delta. So as you can see in this slide, we have delta right here. And you can see that there's just, a variety of different numbers, 0.59, 0.7, 0.79. So usually around a delta 70 is where we would be focusing on for any kind of long call or long put option. Now, the next option, haha, pun intended, that you could do if you would like to trade a ticker in a directional manner would be to turn that long call or that long put into a debit spread. Now, doing this has a variety of benefits, but the number one benefit I would say is that it's a lot more conservative, especially in market volatility. Focusing on being more conservative and protecting your capital is going to be highly, highly important. So when you get into a debit spread, instead of simply a long call or put, you're basically just working on protecting yourself. So of course there's going to be a negative if something's going to be a little bit safer on your money, and that negative is just that you can cap your gains and have limited potential. With a call or put, if you have a call or put on Netflix, let's say that you think Netflix is going to roll over and die, you bought some puts, you're trying to short it, those puts are going to cost at least twice what a debit spread would cost. Okay, but let's say that person A buys long puts on Netflix, person B buys a debit spread on Netflix. Okay, both of them think it's going to go lower, and you want to know who's going to make more money in what situation. Well, in situation number one, let's say that Netflix has some sort of major catastrophe and falls 30% overnight. Okay, very sad. Sorry, Netflix. Person A with just the long puts is going to completely cash out. That's like a trade of the year. Okay, person B who has the spread will only be able to achieve the max profit of the spread. So depending on how they set up their spread, maybe they were setting up for a 5% move in Netflix and they got 30. Okay, so they're only going to be able to capitalize on whatever it was that they were initially targeting. So in that situation, the person who bought the puts is the winner, right? But how often does this really happen? Well, it's happened a few times this year on earnings, right? But it's not something that happens every day. So more often than not, what happens is that the stock market is going to ebb and flow. So in a regular, normal situation, the person B who's just looking for these normal ebbs and flows is going to be in a much better situation by being a little bit more conservative and just trading the normal moves to the downside, because setting up a proper debit spread enables you to pay less for a call or put. So every single time you put on a trade, you're paying this instead of paying this. And when you do that over and over and over and over and over again, it's more beneficial for you. Another major benefit is that it's going to hurt a lot less than directional options in case the stock trades sideways instead of exploding higher. I would love to say I short something immediately right before it goes down the very next day and it falls like a rock, but that's not real life in options trading. Real life is, getting into a trade and you're waiting, you're waiting, boom. Okay. So while you're in this waiting time frame, the person who has long puts, those puts are just decaying over time. They're losing money. The value is going down. But when you have a debit spread, that's not the case because you have a long put and a short put. So your trade will actually hold on to its value during this time frame where you're waiting for something to happen. So that's going to be more beneficial. Now, let's say you're completely and totally wrong. You wanted to short Netflix, and the next day they came out with this amazing show, and everybody signed up, and your trade blows up in your face. Well, the person who has the long puts is going to lose money pretty quickly, and it's probably not going to be all that salvageable depending on how big the move was. Let's say it gapped up 10%. Well, if you have the debit spread, person B, number one, they already spent less money to begin with than this person, so they had less risk on. But also because of the spread, it is not going to move as much or get hurt as much as the long put was. So when you're wrong, it's more beneficial for you. Now, the other great part about this is that you can still make money on the strategy if the underlying trades slowly. And this is higher for a call debit spread, but in the case of a put debit spread, let's say that instead of Netflix falling, 30% overnight, let's say it's just a slow bleed like it has been. Just slowly dying. Typically in that kind of situation, the debit spread is going to be far more beneficial than the puts because remember, if you're buying puts, you need an explosive greater than expected move. If the market's just rolling slowly and it's just, dying a death of 1,000 cuts, then the debit spread is going to work for you in a far more beneficial way. Now, what about the deltas? So we usually do delta 60, delta 30. So the long side of the spread would be the delta 60, and then the short side of the spread would be the delta 30. Let me see if I have that on a slide here. So yeah, here we go. You can do delta 70 as well. You can do delta 70 and delta 20 like it says on this slide right here. If you do the delta 70 versus the delta 60, it's just going to change the price of what it is you're paying, and it's going to change your break-even price. So those are things that you can compare. Generally, what I do, and in this example, this is going to be a call debit spread, not a put debit spread. So in a call debit spread, let's say we're looking at stock cash money again, and your underlying price of your stock is at $100. And let's say that I am super sure that this stock is going to go to $110. Okay. So normally what I would do in this kind of situation is you could set up a debit spread in a variety of ways. You could say, all right, well, let me buy the 100, 110. If you did that, it would be an at the money debit spread. Okay. If you did it instead in the money, like a delta 70, delta 60, you could do 95, 110. If you did it out of the money, you could do 105, 110. Now, usually options traders that don't have as much capital to work with are always going to look at these kind of spreads where they do it out of the money. That's because this kind of spread is going to be significantly cheaper. It's going to be significantly cheaper than an at the money or an in the money spread. Now, I actually will do these sometimes. They are considered more of lotto trades. And, I've focused for a long time on, trading small accounts and that kind of thing. So I don't want to say that, trading out of the money spreads is completely wrong and never do it, because I will do it sometimes. But I'm just telling you that from a sheer probability standpoint, these ones are going to be lowest in probability when compared to the at the money or in the money. And that's because the in the money spreads are going to have intrinsic value. That means that your long option is going to be at a lower price than what the underlying price of the stock actually is, which means it's going to cost more. But if there's market volatility, if the market just trades sideways, if it doesn't, really go anywhere, this is going to be your best bet because it's going to hold on to its value more. These are only going to work if the underlying price skyrockets higher and ends up in between your spread. So let's say, cash money is trading at $100. You bought the out of the money spread 105, 110. Well, then let's say for 2 weeks after that, cash money does nothing and it sits at the $100 price point. Goes nowhere. Just chops, 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 which happens a lot, right? What happens is the value of the options that you bought are going to decay over time. But let's say in the other situation, you actually have a setup where you bought cash money. It was trading at $100. There was a huge move, big news story. You had this out of the money spread, and all of a sudden, cash money is up at $107. That is where you would really make out well, because you bought something that was super cheap and out of the money, and it exploded and it went directly in the middle of your spread. So break even means what for a debit spread? So on a debit spread, you are going to be paying a premium to pay for the spread. Okay. So it's going to be different than with a credit spread, where you're going to be selling premium. With a debit spread in particular, what you are going to be doing is, let's say that you paid, let's say that the stock again is just trading at $100, and let's say that you paid $2 for your spread. Okay. You paid $2 and you bought the 100, 110. You got a really good deal. Well, what that means is that you paid $2 to try to capitalize on a $10 move. Okay. When you place your second strike at 110, that is where you cap your gains. So if there's some explosive move or anything like that, your gains are capped at 110. It doesn't matter if it goes to 130. You're only ever going to make the spread, which is $10. Okay. But you got a deal because a long Delta 70 call was $5. So you saved yourself some money. So what it means when you get to break even price is that your spread is worth at least $2. Okay. And then once it starts going over the value of $2, like let's say it's worth $3 and then it's worth $4. Well, now it's worth twice what you paid. But if it goes below $2, then you're losing money, right? Because you paid $2, and if it's only worth $150, you're losing money. Does that all make sense? So, for example, there's a couple different ways that you can look at this in the options chain. But essentially, when you're looking in your options chain in your trading platform, it's usually going to look something like this, just depending on what platform you have. Normally, it's going to set it up as a vertical. So what you're doing is you're going to be buying one long option and then selling a short option. If it is a call debit spread, then it would look something like this, where you're buying the long option right here. This is the long option. And then up at a higher strike price, you are going to be selling an option. So really the only difference from, buying a long call versus buying a debit spread is that if you just bought the long call, this would be what you bought, right? Let's say you bought the long 12.25. This is pre-split prices, obviously. Now, if you want to turn it into a spread, all you're doing is you're just adding another strike higher up in the options chain, usually around a delta 20 or a delta 30, and you're selling that option to go with the option you bought. It has to be in the same expiration series or it's not going to be a spread. And what that does is it gives you an overall price. So you have to spend money on the debit right here, but when you sell the option right here, that means you get a credit. So what it does is it brings down the overall cost, because if you just buy the 12.25, in this example, pre-split Google prices, let's say that the long call was like $65. Okay. Well, instead of paying $65, what you did was you sold another option up here, and that brought down the cost that you actually had to pay, because you were able to get a credit for this one right here. And then you only had to pay $30 instead of 65. It's good, right? It's a deal. So I personally significantly prefer, buying a debit spread versus versus just a long call, because I like to bring my cost basis down. I like to have a strategy on that is going to benefit me when the market is choppy. I also like to use a strategy that, if I'm completely wrong and it blows up in my face, I'm going to lose less money than I would otherwise. And I also just like to sleep a little bit easier at night. It's really fun to have long calls or puts, just when the market's exploding. If it's exploding to the upside or if it's rolling over and dying to the downside, it's great to just have the long call or put. But those times are, that only occurs like 20 to 30% of the time. So the rest of the time when you are in the market, it is going to be much more beneficial, in the long road, to be focusing on multi-leg option strategies, because it saves you money, it's more conservative, and it will enable you to really be in the long game versus kind of like the short one-hit wonder type of game. Yeah, does that make sense? What is your typical expiration date time frame? 30 days, 2 weeks, any shorter? So that 100% depends on what kind of target you are looking for in the market. So, for example, let's just look at this NASDAQ chart. I know that this is a little messy because I have all my fibs on here. But basically what I'm doing with this chart is looking to identify price targets. Now, the QQQs just broke 290. Okay. That was a major area of support. It was a major price target that I had. I actually had a spread set up in my Mastery for 290 and I already took profits on it. So then the next question is, okay, well, what's the next price target? And your question is, well, the next question is, how do you know when to set up the time frame of the trade? It 100% all depends on the setup and the price target. So let's say that you said, hey, Danielle, I think the NASDAQ is going to completely roll over and die, and I want to trade it to new lows. Okay? Let's say that you thought that the NASDAQ was going to hit, let's say, 250, 260. Okay? Now, let's say someone else says, hey, you know what? I actually don't think it's going to fall that far. I only think it's going to hit 280. Right now, we're sitting at 286. I don't want to try to go for gold here. I'm just trying to go for the next leg lower. That is going to depend how you set up your trade. So let's say, person A wants to target 280. Let's do that one first. So you're going to go to your options chain and you are going to say, okay, right now the NASDAQ is trading at 287. How many dollars away is 280? Well, let's see, expiration date. So in 3 days, the NASDAQ has a $5.77 move. Could it be at 280 in 3 days? Yeah, I mean, it could if there's, something crazy, some kind of news related event. It's not 100% within the expected move, but it could. What about 5 days? Okay, now we have a $10 expected move. So my question to you would be, is it reasonable to bet on the QQQs hitting a price of 280 within a 5-day time frame? Yes or no? Well, yes, it is, because when you're looking at the options chain, the market makers are telling you that that is how much the QQQs are likely to move in the next 5 days. What if person B says, hey, you know what? I want to target $250 in the Qs, and I think it's going to happen by, an expiration date of 5 days away. Is that likely to happen? It's going to be a $37 move. No, that's highly unlikely to happen. It could. There could be a flash crash. There could be a black swan event. But it is highly, highly unlikely because the market makers and the options chain are telling you that in order for the Qs to hit 250, you're really looking at, $37, $40 move. Okay? So in that case, you'd have to go down here and you'd have to say, okay, well, when could the NASDAQ actually move down to a 250 strike price? Let's see, $40. So we've got November expiration series telling you that you have about, $32 move? December expiration series is telling you have about a $40 move. So, let's say November, December. November would be the more aggressive approach. December would be the more conservative approach. So for the person who wanted to just target 280, what I would say personally is I would say, okay, let's see, September 21st, it's going to be a Wednesday. Do we want to do September 21st or do you want to do September 23rd to give yourself a little bit more time? 23rd would be a Friday. That would be a $12 expected move. Just trying to be a little bit more conservative. At that point, you'd go down to your options chain to set up a spread. So if you just did it in, the super basic way where you say, okay, I'm looking at a Delta 60, Delta 60, Delta 30. That would give you the strikes of, let's see, either 292 or 291 and then 280. Okay. Normally, I try to make mine a little bit more, I try to pick like big round numbers. So you see how there's a lot of open interest right here at 290. So I would actually pick that even though it's the delta 56. So 290, 280 would make it nice, round, and even. So at that point, you have a 290, 280. So in this example, for this trade, you would be paying a debit of $4.31. The max amount you could ever make would be $10. Or you could ever close it for, not that you could ever make. So if you pay $4.31 and the max you could ever close the trade for would be the width of the spread, that would be $10. But you have to remember, you have to subtract what you paid. Okay, so when you look at a risk reward on something like that, your max profit is $5.71. Your max loss is $4.29. Pretty good, right? I would say it's almost 1-to-1. So that person trying to target 280 could either do it by September 23rd, or if you move your date down a little bit, let's do September 21st. It's going to be $4.31, pretty much the same. Okay, so that is how I would look at setting it up. If person B wants to bet on the NASDAQ, completely dying by the end of the year and trading all the way down to 250, that's actually a situation where I would do it as a little bit more of a lotto trade personally, because I think that the Delta 60, Delta 30 is probably going to be way too expensive, but let's see. So Delta 60, that would be about what, 300, and then 250 is going to be the Delta 20. So let's just see what that looks like. Buy, vertical, 300, 250. For one contract, that's going to cost you $17.50. Okay. The max amount you would ever be able to close this trade for would be $50, because the width of the spread is $50. So if you want to figure out how much you could make, you would have to do $50 minus your cost. Okay. And that would equal your max profit, which thankfully it'll calculate it for you right here. So your max loss would be what you would pay, $17.53, and your max profit would be the width of the spread minus what you paid, which would be $3,247. Now notice your risk reward. You're risking about 1 to make 2, which is a pretty good risk to reward. Let's say that you didn't want to set up a spread and you just wanted to buy the puts. You're like, you know what? The spreads are way too complicated. If you just bought the put, the put is going to cost you about $23.60. So $2,360 for just the put. Or I don't remember exactly what it was for the spread, but it was like $1,700 something, right? Whoops, not 1,700. Or 17,000. So if the spread versus the put is up for debate, and the put is going to cost you $2,360, or the spread is going to cost you $1,760, you have a pretty good discount, right? The only, the main thing about this is that if the NASDAQ actually falls to below this strike, if the NASDAQ fell to like 220, let's say, the person who bought the put would make more. But that's highly, highly unlikely. So it's like, well, might as well spend less, right? In the other example that we already looked at, the put versus the spread, if you just bought the put instead of the spread, you would be paying, what, $7.66? But if you make it a spread, you cut that cost basis in half. You're only paying like $4.30. Does that make sense? So we're actually not going to have time to get into credit spreads and butterflies as well. So we'll be happy to follow this up with a secondary presentation where I can just focus on those. Because I definitely want to make sure that I, go over them well enough so that you leave here feeling like you made a good use of your Friday afternoon. So in the interest of, going over something in detail, I would be happy to do a follow-up session on, credit spreads and butterflies. But what I really wanted to focus on here today was, the difference between doing a long call and put, or doing a debit spread, and the positive and negative results for each one of those things. Because I really do, I know even for me, when I first started learning options, I was like, what? Spreads? It's crazy. This is so complicated. Like, why would I do that? But as someone who was starting out with a small account, I quickly learned that even though trading long options can be great at the right moments in time, as an overall strategy that you're implementing all the time, being able to bring down your risk, being able to bring down your cost basis is highly beneficial. And most of all, being able to bring down your anxiety and sleep well at night. And that's something that trading spreads is something really enables you to do. So if you would like more resources, we have tons of resources here at Simpler in the free trading room on YouTube. I primarily use spreads. A lot of us primarily use spreads in our options trading room and in our masteries. So you can definitely learn more about each one of us. Within Simpler Trading, you can go to, let's see, if you go to our main site right here, you can click on this and you can learn all about our different traders and our different trading strategies that we have. This is me right here. You can learn just a little bit more about my strategy. I also have a newsletter where I write up a couple different times per week. It's called 5startrader.com, where basically I go through, different setups, macro ideas, talk about my notes from TV when I go in CNBC and stuff like that. You can also follow me on Twitter. So my handle is going to be at Trader Danielle, TraderDanielle. So you can check all that out. Other than that, be on the lookout for another class from me in here. I'm not exactly sure when my next one will be, but I'm going to be diving deeper into Options 101. So stay on the lookout. This recording is going to be posted, and we can post it in here after it's all completed and set up, so you can go over the recording. And yeah, excellent. All right. Well, I hope everybody has a great rest of your Friday. Sorry for going over time a bit here, but I hope this has been beneficial, and I will see you next time.